In the quiet dawn of June 9, 2008, a seemingly tragic scene unfolded atop Bear Mountain Bridge in New York. A Cadillac Escalade sat abandoned, a chilling suicide note left inside. The message was stark: suicide by cop, and do not resuscitate. Authorities, believing Samuel Israel III, a prominent hedge fund manager, had ended his life by plunging into the Hudson River, launched an immediate, desperate search. But this was no ordinary tragedy. It was a meticulously planned deception, the latest, most audacious act in a complex web of fraud designed to escape a colossal $450 million debt and a looming prison sentence. Before the staged disappearance, Samuel Israel III was the ambitious founder of Bayou Hedge Fund. Launched with promises of sophisticated trading strategies and consistent performance, Bayou quickly attracted a significant roster of investors. The fund was positioned as a beacon of stability, offering a rare blend of high returns with supposedly low risk. Investors, seeking a reliable haven for their capital, poured millions into Israel's venture, trusting in his expertise and the allure of steady, positive returns in an often volatile market landscape. Bayou's core appeal lay in its consistent track record, at least on paper. Samuel Israel III cultivated an image of financial prowess, promising investors not just growth, but predictable, positive returns month after month. This steady performance was the bedrock of investor confidence, drawing in more capital as word spread of Bayou's seemingly infallible strategy. In a world where financial markets swung wildly, Bayou appeared to offer a safe harbor, delivering on its ambitious pledges and cementing its reputation as a reliable, high-performing hedge fund. Despite the outwardly stable facade, trouble began to brew beneath Bayou's surface. The sophisticated trading strategies that promised consistent gains started to falter, and the fund began losing money. These weren't minor fluctuations, the losses were significant, threatening to expose the true fragility of Israel's operation. Admitting these losses would have shattered investor confidence, leading to massive withdrawals and the swift collapse of his financial empire. Faced with this impending reality, Israel chose a different, far more perilous path: deception. To conceal the burgeoning losses, Samuel Israel III devised an audacious plan: he would create a fake accounting firm. This phantom entity, named Richmond Light, was designed specifically to serve one purpose: to approve Bayou's falsified numbers. It was a sophisticated smokescreen, giving the illusion of independent oversight where none existed. Richmond Light's address was a post office box, and its operations were entirely fictional, yet it provided the crucial stamp of approval that allowed Bayou to continue reporting fabricated profits to its unsuspecting investors. Richmond Light became the keystone of Israel's elaborate fraud. With the fake firm in place, Bayou's internal accounting team could manipulate the true financial statements, inflating profits and completely omitting losses. These doctored books were then sent to Richmond Light, which would, predictably, approve them. This fraudulent approval created an undeniable paper trail, complete with official-looking audits and certified statements, all designed to reassure investors that their money was safe and growing, even as it evaporated into the abyss of Bayou's failed trades. This intricate scheme wasn't a short-term fix, it was a strategy that lasted for years. For an extended period, Samuel Israel III successfully hid Bayou's mounting losses, perpetually rolling over the deception to avoid detection. Each passing quarter meant more sophisticated manipulation of figures, deeper layers of fabricated documents, and an ever-growing chasm between reality and the glowing reports sent to investors. The longer the fraud continued, the larger the sum of concealed losses became, turning a manageable problem into an insurmountable financial black hole. As the losses compounded, so did the audacity of the fraud. What began as an attempt to mask initial trading failures evolved into a massive, systemic deception. Israel had to continuously raise new capital from unsuspecting investors to cover the fictional returns promised to existing ones, a classic Ponzi-like structure. The scale was staggering, hundreds of millions of dollars were being siphoned away, yet Bayou's reports continued to show robust profits, maintaining the illusion of a thriving, successful hedge fund. The pressure on Israel to keep the charade going was immense. Ultimately, the total value of the fraud orchestrated by Samuel Israel III reached a staggering $450 million. This monumental figure represented the collective savings and investments of countless individuals and institutions who believed in Bayou's promise. It was not merely a number on a balance sheet, it was retirement funds, college savings, and lifelong dreams systematically plundered by a single individual's deceit. The depth of the betrayal, and the sheer volume of wealth that vanished, would leave a devastating impact on the lives of those who had entrusted Israel with their financial futures. No fraud, however elaborate, can last forever. In 2005, Samuel Israel III's meticulously constructed house of cards finally collapsed. The persistent losses, the growing scrutiny, and the sheer impossibility of maintaining the fabricated accounting for much longer led to the scheme's inevitable unraveling. The collapse sent shockwaves through the financial world, revealing the full extent of the deception and exposing Richmond Light for the sham it was. The steady returns Bayou had so proudly reported were unmasked as a cruel illusion, leaving investors devastated and authorities moving in to investigate. With the fraud exposed, Samuel Israel III faced the full force of the law. Investigations quickly mounted, detailing the systematic deception involving Richmond Light and the multi-million-dollar losses. Faced with overwhelming evidence, Israel pleaded guilty to fraud charges, admitting his role in orchestrating the elaborate scheme. This plea was a concession to the undeniable facts, a formal acknowledgement of the years of deceit he had maintained. But the legal battle was far from over. The consequences for his actions were still to be determined by the courts. Justice, though slow, eventually arrived. Samuel Israel III was sentenced to 20 years in prison for his role in the Bayou Hedge Fund fraud. This was a severe sentence, reflecting the massive scale of the deception and the devastating impact it had on hundreds of investors. He was scheduled to report to prison in June 2008. The reality of 2 decades behind bars, a stark contrast to his lavish lifestyle, loomed large. The date of his incarceration became an inescapable deadline, pushing Israel to the brink of desperation and fueling his next audacious act. With the deadline for prison rapidly approaching, Samuel Israel III devised a desperate, last-ditch plan to escape his fate. He would stage his own suicide. This wasn't merely a flight, it was an elaborate performance intended to mislead authorities and the public into believing he was dead. The motivation was clear: to evade the long prison sentence that awaited him and disappear without a trace. It was a calculated risk, betting that the belief in his demise would grant him the freedom he desperately craved, even if it meant abandoning his previous life entirely. On June 9, 2008, the plan was set in motion. Israel parked his Cadillac Escalade on the majestic Bear Mountain Bridge in Bear Mountain State Park, New York. Inside, he left a carefully crafted suicide note designed to convince anyone who found it of his tragic end. The note included phrases like "suicide by cop" and ominously stated, "Do not resuscitate." This carefully staged scene, overlooking the vast Hudson River, was intended to be the final chapter in Samuel Israel III's public life, paving the way for his clandestine escape. Upon discovering the abandoned Cadillac and the note, authorities immediately launched a massive search operation. The belief was that Samuel Israel III had jumped into the swift currents of the Hudson River. Teams combed the riverbanks, used sonar equipment, and deployed divers, all searching for a body that wasn't there. This intense effort to recover his remains was a public spectacle, consuming vast resources and generating significant media attention, all while Israel himself was meticulously carrying out the next phase of his elaborate disappearance. 4 weeks, Samuel Israel III was a fugitive. While the world believed him dead, he was actively on the run, attempting to forge a new life in anonymity. Details of his movements during this period are sparse, but the pressure to remain undetected must have been immense. Every shadow, every glance, could potentially reveal his true identity. Despite the elaborate planning, living a life constantly looking over one's shoulder, separated from everything familiar, proved to be an unsustainable existence. The freedom he sought was quickly becoming a new kind of prison. The illusion of Israel's death finally shattered on July 2, 2008. After weeks on the lam, Samuel Israel III turned himself in at a general store in Southwick, Massachusetts. Exhausted, perhaps realizing the futility of his escape, he walked into the store and made contact with authorities, ending his brief period as a fugitive. His capture confirmed what some had suspected: the suicide was a hoax. The dramatic disappearance that had captivated headlines concluded not with a tragic discovery, but with the quiet surrender of a man who could run no further. Samuel Israel III's audacious escape attempt only deepened his legal troubles. He subsequently pleaded guilty to escape from custody, adding another charge to his already extensive list. For this new offense, he received an additional 2-year prison sentence, which was tacked onto his original 20-year term. The staged suicide, intended to grant him freedom, ultimately only prolonged his time behind bars. His desperate act solidified his reputation not just as a financial fraudster, but as a man willing to go to extreme, deceptive lengths to avoid responsibility. The legacy of Samuel Israel III and Bayou Hedge Fund is one of profound betrayal and immense financial ruin. His sophisticated scheme, hidden by a fake accounting firm, ultimately cost investors $450 million. Beyond the monetary loss, there was the devastating erosion of trust, the shattered dreams of retirement, and the profound emotional toll on those who were defrauded. Israel's story serves as a stark warning about the allure of unrealistic returns, the dangers of unchecked financial power, and the lengths to which some will go to evade justice, leaving a trail of destruction in their wake.